Now we discuss financial statement analysis. We already studied what are the financial statements consist of. It consists of trading and profit and loss account and balance sheet. This trading and profit and loss account is generally called income statement. And such an income statement and balance sheet is analyzed to find out the financial strength and the performance strength of a business organization. And here we explain about comparative income statement analysis. This financial statement analysis consists of several types of analysis such as comparative statements, common size statements, trend analysis, etc. And now we discuss about comparative statement analysis, and it consists of two items: comparative income statement and comparative balance sheet. So, financial statement analysis is done through comparative statement analysis, and this comparative statement analysis consists of two things. One is comparative income statement and another one comparative balance sheet. Now we discuss comparative income statement. And here is a question. Prepare a comparative statement from the following. 2-year data are given in your question for 2015 and for 2016. Net sales, cost of goods sold for 2 years, administrative expense, selling expense, interest paid, and income tax. These are the items given in your question. We know that net sales is the income of the organization. Cost of goods sold is associated with a direct expense or expenses to be considered in the trading accounts. This administrative expense and selling expense are connected to business, usually called operating expense, because for doing business it is required to spend administration expenses and selling expense. And interest paid, this interest paid is usually called non-operating expense, because even if the business organization is not in operative condition, the business organization is liable to pay interest. Okay, but this administration and selling expense are required only when the business is in operation. But this interest paid, even if the business is stopped for some time, the interest must be paid because it is an obligation. So it is called a non-operating expense. Then income tax. Income tax has no direct connection with the business, because we need not to pay income tax to conduct the business. But when we get profit from business, we have to pay income tax. So it is not a relevant expense of business. Okay, so these are the nature of expenses in this question. Sales is there, cost of goods sold means the direct expenses, administration and selling expenses are related to operating expense, interest paid is non-operating expense, and on income tax is legal obligation. Okay, only if the business organization earns profit, it earns income, it earns profit, it is liable to pay income tax. Okay, so this is the nature of the items appear in the question. Now we prepare a comparative income statement out of this question. Okay. See, at first we have to arrange the items in this order. We should consider the net sales first. And from this net sales, we have to deduct a cost of goods sold. when we deduct a cost of goods sold from this net sales, we get a gross profit. Okay. After that, we have to consider operating expenses. In this question, I already told you that there exist two expenses, administrative expense and selling expenses. These operating expenses are together deducted from this gross profit. Then we get operating profit. Here administration, selling expense, these two are operating expenses. We are taking the total of this operating expense, total of these two items, and we deduct this operating expense from the gross profit. Then we get a operating profit. Out of this operating profit, we have to deduct the non-operating expense, which is interest. We deduct interest out of this operating profit, and then we get net profit before tax. From this amount, we have to deduct the tax, that means income tax. On deducting income tax from this amount, we get net profit after tax. So this is a format of execution of this comparative income statement. Okay, net sales is to be taken first, cost of goods sold is to be deducted, then get gross profit, and all operating expenses, administration expense, selling expense, or any operating expense are there, they should be taken together, which forms total operating expense. That is to be deducted from gross profit. We get operating profit. From the operating profit, we have to deduct non-operating expenses like interest, and we get net profit before tax. From this net profit before tax, when we deduct income tax or tax, we get net profit after tax. Okay, this is the format. I explain the solution in the next video. Okay.